Good afternoon, one and all. I hope we all enjoyed lunch, and if you need to get up, shake it out at any time, please do so. My name is David Bradbury. I'm a UVM graduate, and I'm the president of the Vermont Center for Emerging Technologies, and welcome to this afternoon's panel. Thanks, Nicole. Yeah. Many of you won't recognize me today in a suit. Usually my garb is T-shirts, yeah, there you go, and a hoodie. So thank you for recognizing me, to those in the back. Our panel today really was going to try to build upon the investor reveals and the company pitches that just occurred, and talk about how you find investor alignment, what's a good funding source fit for your stage of company or the goals you have with a company. And we're going to dive into that with a few prompted questions from our expert panel. And really, they represent a continuum from very early pre-idea, early commercialization, how do I access federal resources, for example, through seed investing, Series A investing, secured debt and lending, what it takes to secure those sorts of funds today, and then also public companies. How do you get to be one? What do they look for? How are they valued? Maybe also, too, what the activity is like today. What are they doing with their money? Are they buying things or not? And really give a sense, because you all have varied backgrounds, experiences, and stages here today. And then we'll take some questions at the end. Okay? I'd like to first ask each panelist to give us your 2-minute pitch of who you are, what you do, if you would, and I hate going in order, so I'm going to jumble around a bit. Maybe Angela, can you kick it off, please?
Can you hear me okay? All right, so I'm Angela. I work for a company called Simbex, which is actually based in New Hampshire, just over the border, but we're close to Vermont, so it's fine. We are a medical device design and development company. We do engineering, and then I'm actually in charge of the commercialization strategy part of the company. So we work with folks from a very early stage, sometimes as early as a napkin sketch, to help them really realize their innovation idea and bring it to market. And then my end of the task is to make sure that they have a plan to move forward into the investment world. So I'm kind of the odd one out on this panel as not an investor, but someone who helps like in the pre-investor stage.
Great. Skier or snowboarder?
Neither.
Oh.
I will snowshoe if pressed.
Oh, that's a reveal right there. Okay, thank you. Corey, how about you? Could you say hello, please?
Yeah, sure. My name is Corey Bronner. I am deputy CIO at a local firm that many of you probably have never heard of, called Champlain Investment Partners. And so we are an institutional asset manager. Our specialty is small and mid-cap publicly traded stocks, and we manage about $16 billion. But mostly for institutions. So again, it's probably why you have never heard of us. I'm from Vermont, went to UVM, care deeply about this state, and am really excited to be here. And I know the public equity aspect of this is probably not super applicable, but it is maybe interesting if anyone ever gets to that stage.
Great, thank you. And Geoff, welcome. As an entrepreneur yourself now, so could you tell us a little about yourself and your company?
Sure. Thank you, David. My name is Geoff Hesslink. I'm a University of Vermont graduate. I serve as the president of Bank of Burlington. Bank of Burlington is a new bank, traditional bank in many ways. We take deposits and we make loans. Our bank focuses on making loans to companies. We provide growth capital to Vermont businesses. And another aspect of the company that's a little bit unique is we're focused heavily on technology to deliver our products and services, because we think that's a better way to serve customers. And I too am happy to be here. I thank you for having me. We want to make this valuable, so please let us know if you have questions or how we can help.
Great, thank you. And Jenny.
Hi, everybody, and thank you to UVM for hosting us. Hi, Corinne. I'm the founder of Features Capital, a venture fund headquartered in Norwich, Vermont. We invest in seed, Series A, and Series B stage companies, predominantly in the medtech space. I've been in medtech since 1999, and I've worked with publicly traded companies, a lot of sell-side M&A and private financings, and I've been on the investor side since 2016. And looking forward to diving in onto what makes a great investment. And I've been skiing in Vermont for 45 years.
Is there any snowboarder up here other than myself? All right, we'll work on that for next year, right? We'll get that. And I realize VCET's been mentioned a couple times the last few days, and really what we're about, we're a nonprofit with a few for-profit subsidiaries that since 2005, when doors opened over in Farrell Hall, we try to provide actionable advantages to teams that are starting and scaling their firms with the people they need to meet, the resources they need to find, and the protein sources they need to fund and grow their business. All right, Jenny, I want to stick with you, please, if we can, and get to the first question about alignment and trying to help folks demystify this process of sources of capital and their needs, and how do you think about stages and maybe what your fund's looking for as a perspective to share?
Sure. Well, I think alignment is really a key word here. And, we're all humans. We're all trying to build something bigger than just our individual selves. And especially here in Vermont, making sure a lot of folks are making sure there's an impact focus or something that's beyond ourselves. So that alignment with an investor really comes down to what are your personal values? What are your goals? How is your company then going to achieve what it needs to achieve based on your input as a founder or as the executive team or as an investor? So in terms of companies, we do get to know companies very early. Oftentimes we follow them for quite some time, sometimes up to 2 years, before actually committing. And that's where we can see traction and progress and achieving goals, goal setting and advisory as to how to achieve those goals. When it comes to alignment with your investor base, if it's a clean tech fund, an ag tech fund, healthcare, consumer, real estate, you never know what might be out there. It's finding that partner who has the knowledge of that industry space to then be your go-to partner. So I think from the alignment standpoint, you're not selling. You're not selling a deal or selling, a transaction. It's a partnership, and some of these partnerships last a long time. So in thinking about the investors' side of the table, these are some of the things we're thinking about too.
And you have LPs. What is that, and why should I care as a capital seeker?
Sure. So venture funds and private equity funds have their backing by large institutions or individuals, trusts, endowments, foundations, family offices, sovereign wealth. Those are our sources of capital. We are a fiduciary. Our job is to link the sources of capital with the innovators, with the portfolio companies, and to due diligence and build a diverse portfolio. Compared to angel investing, it's an individual decision with an individual check into a company, whereas a venture fund is a pool of capital that goes into a portfolio that we then manage and build liquidity for the LPs. So they may also be funds as well, so like fund of funds.
Great, thank you. And I want to jump over to Angela to sort of describe, what are you looking for when you take on a team?
So we're not investing money into the team, but we will be investing a lot of time with them. So we really look for a personal fit with the innovator in our company. We do kind of a long, almost like interview process. We'll do a couple of prospecting calls and really discuss what this person's vision is. And we're interested in not only what their innovation is, but also what their goal for that innovation is. We want to see an impact on the human side of things. So we want a direct line to something that's actually going to change healthcare or change the way that someone gets treated for an injury or an illness. We really like to be able to point to a technology that's out there being used and say, we helped with that. And so that's one of our main kind of motivations when we're picking somebody to work with.
And how early is too early to reach out to you?
So unusually for us, you can't be too early. In fact, we prefer that you're as early as possible because sometimes we have to provide input that will necessitate a pivot, and it's a lot easier and cheaper to do that pivot early on. So I say napkin sketch, people actually do come to us with something that's just drawn out on paper, and that actually works just fine. They just need kind of the spark of an idea, and then we can run them through the whole process from that spark of the idea. They do have to be willing to commit a pretty large chunk of their own time to this thing if it's going to be that early. And so they also need to kind of show that they have the wherewithal to stick with this idea.
That's really helpful. And then the first funding source externally that you often see with the folks you work with, could you describe that?
Yeah, most often for us, it's non-dilutive funding as their first source. So their own pocket money is probably going into the first prototype, and then after that, they're using that to apply to a government grant like an SBIR or STTR grant. And then, that kind of helps prove their concept so that they have a little momentum to go forward and look for some investor capital.
Great, super. And Geoff, from a bank's perspective, you have a whole other layer of regulatory, fiduciary duties and perspective. Could you just describe what a typical, soon qualified applicant might look like?
Sure. And I'll start by echoing Angela and Jenny's comments. They had it, I think, spot on. Capital providers, no matter what type of capital we provide, it's a relationship business, and we all work hard to build relationships with folks. And I think you all would be well served to understand that, right? You've heard it 3 times now, but relationships do matter, and that's accretive to the process, no matter who the capital provider is. So banks, what do banks do? Banks provide debt. Right, so there's no dilution to ownership with banks' capital. The cost of bank debt is low relative to other capital sources. So those are a couple of fundamental aspects of it. And I would tell you the typical bank customer is a profitable company that has revenue growth, and that revenue growth requires asset growth. And it's the bank's role to fund that asset growth. That's what we do in the context of making those loan granting decisions. It begins and ends with management, right? We're buying people at the end of the day, and character and competence are the major aspects of that. Of course, there's a financial analysis done on the financial condition and performance of the company, and we like to understand that the industry has a stable, if not positive, outlook. Those are, at a high level, some of the things that go into granting bank loans.
Does the word collateral ever come into the discussion? And
yeah, so
how
I
do you
left
view
that out.
that? Yes.
David, thank you. So I told you banks provide debt. We actually, and that's true. It's secured debt, which means the typical bank financing transaction, the company will pledge its assets as collateral for the loan. And that's an aspect of the underwriting and the credit granting position, but I would impress upon you it's the least important aspect. It's really about the competence of the management team, the company's performance, and its outlook.
And one last question for you before we get to Corey. Out of 10 applicants, how many do you typically say yes to? And I'm going to ask Angela and Jenny, too, to give me those numbers, and we'll get to Corey.
So that's a good question. I'm going to have to think about it. I will say if we've done a good job, right? And we've communicated and built relationships with our customers. And mind you, we're talking about the granting of loans, and banks provide deposit products as well, right? Checking accounts and other types of savings vehicles. And that's a very good time for a bank and a client to develop a relationship that can grow into a lending relationship. So, David, if we're doing a good job in talking to our customers early and understand when they're applying for credit, they know they're eligible for it, and we grant it. If you had asked me how many of the unsolicited requests for credit get approved, it's I'm going to guess 30%.
30%? Oh, still pretty high. What about you, Angela? How many taken on versus those inbounds?
So provided that they're in the segment that we work in, so there's a kind of a pre-screen, it's close to 75%. So
alignment up front that you're the appropriate source for that stage and that
yeah,
that
because
sector.
we're early stage, so we have the opportunity to allow them to make that go, no-go decision after they've worked with us.
Got it. Jenny, what do you think?
So we started a year ago, March. It's probably been at least 500 companies. We've done 3.
3? Okay, 3 to 500. Okay. I would say at VCET too, we work with over 300 teams a year. Maybe half want money of some sort, and from our direct investing venture funds, I think over last year we've done 5 or 6 new ones. So that's about the hit. The odds are tough, folks. It's a lot easier to sell to your customer and use their money, right, if you can. So Corey, help us understand why the public markets are important, okay, and how they drive back down through the whole capital stack, okay, in terms of relative valuations or how businesses are judged, and any sort of demystifying along the importance of that would be helpful.
Yeah, so the public markets are interesting because often when we're making an investment, we're just transacting with another investor that's selling that investment. So the primary function of the public markets is actually to give individuals that were early investors or founders liquidity. And it actually creates a little bit of a conflict because they're incentivized to sell at a maximum price and maximize their investment. And we want to buy things that are reasonably priced. So at Champlain, we don't often think of it as we're investing directly in a company, but we are betting on the future. And betting is not a great word, but we're investing in the future of those companies. And the way it all feeds back is you get pretty much instant data in the public markets. You know what you're paying for every instrument, who else is invested in it. And the way that all filters back down to the private space is it often sets the tone for valuation rounds. It sets the tone for the flow of capital. So last year, the public markets were really tough, and it filtered right down, and it made funding for private and startups a lot harder to come by. And the first mechanism there is often the public markets to kind of drive that conversation or that tightening of capital. So the public markets, like I said, are interesting because it's often a transaction between investors where you're expressing opinions on companies, and you get to know those companies just as well sometimes, but you're not always a partner in the same way that these other individuals are, because you're not dictating strategy, and you're not sitting at boardrooms and offering that more intimate partnership that you do in the private rounds.
Yeah, I mean, one of your advantages, you get to vote with your feet. You can sell off that relationship and find something else versus
Yes.
Geoff, Angela, Jenny, ourselves. We're in these companies for 4 years. Sometimes it seems a lifetime, right? Other times it goes much more quickly. So, Jenny, I want to ask you, for your fund, your thesis, I just really get a little bit more granular on what this med tech focused venture fund is looking for, because I think it's really informative when we go to look at alignment on who do I call or email or network into, that you really dig down a little bit beyond the headline on the website. So
Yeah, this is a really good point. So thanks, Dave. So med tech for us is a little bit of a broad definition. Implantable surgical tools, anything that a surgeon or doctor would use for a procedure that gets sold to the call point, so the physician or the hospital system, the ASC, or the home. So treating patients at home, monitoring the patients at home. We also look at SaaS, consumer wearables, AI, things like that. So med tech for us is a little bit broader. We stay away from CRISPR and DNA and mRNA and things like that. We are open to diagnostics and tools. I've done a diagnostics deal, and oftentimes that's with a partner fund that really has deep expertise in that space.
Thank you. That is really helpful. Corey, from your perspective on public markets, like, is this med device, med tech exciting?
Yeah, it's one of our favorite spaces because the innovation just never stops. So from a weighting perspective within our portfolio, healthcare, and almost all of it is med device, is often our biggest single allocation. Things like biologics and molecular sciences are very binary in their outcomes. So as a public investor that's looking to make money for clients and manage risk, binary outcomes are just not great. And so we don't have enough PhDs on staff to differentiate in that space. But the med device space, like I said, it's just so littered with great outcomes and use cases. And then there is often a voracious appetite for large cap medical device companies, conglomerates to acquire them. So it's just a very fertile ground for opportunities.
Great. And Angela, I'm curious, what do you really look for when they come in with their notebook or their patent application? Like what things do you really weigh as most important for that initial onboarding?
So we look for common barriers because we are used to kind of seeing the outcomes of these folks. So we try to anticipate barriers that they're going to run into early. So we look for folks that are not going to hit those barriers too hard. Some of the most common ones are regulatory. So if the FDA is going to give them a really long runaround before they can get to the market, then that is a barrier that might make them non-viable. Reimbursement is another one that we look at. So that's if the insurance company is actually going to pay for this product. And those two by themselves probably account for most of the early stage failures that we see. Oftentimes there's nothing wrong with the technological idea. It just doesn't fit into the workflow and the clinical landscape.
And how much weight do you put on having a patent up front, or do you help people obtain those or sort of come up with strategies?
It's insignificant on the list of things that we look for.
Wow, yeah. I see some people reacting out there.
Yeah.
Why do you say that?
Very often, this is kind of an incremental change, so it's a better mousetrap. It's just integrating tech into something that hasn't had tech before, and sometimes it's just not patentable. That's pretty common in our space. A lot of times people are like afraid to even talk about their idea because they're worried about, violating the confidentiality of their IP that they haven't filed yet. We definitely encourage more of that kind of integration type mindset, kind of a little bit more like open source, like software folks think, because we see a lot more additive value that way, as opposed to just kind of trying to keep their own value to themselves.
And do you work with college and university commercialization offices or other commercialization advisors, or is it just the founder one-on-one?
No, technology transfer offices are a really common way that we connect with folks. So a technology transfer office usually has a wide spectrum of people that they have to serve, and maybe they are better equipped for different segments than others. Med tech and med device is just really kind of technical and focused, and so oftentimes they find it easier to hand those people over to us because that's something that we do every day.
Yeah. And Geoff, a question around some of the underwriting perspective, please, if you can. Great, high margin, high profit, high growth. Okay, I could see where you might want to fund that, right? But if we have high growth, maybe margins aren't what they need to be because scale hasn't been reached on a unit basis or build out, or they're reinvesting in plant and equipment. Like, what sort of judgment factors come in for getting something maybe to the next phase for deeper due diligence?
Yeah, you used the right word. It's judgment. There's no algorithm or mathematical formula, right? It's, as you point out, David, companies have different strategies around margin and growth and whatnot, and we lend regularly into all of them. What I would say, we found that the best companies that I've seen in my career have very clear understanding of their competitive advantage. And that sounds silly and simple, but it's actually pretty complicated to hold up a mirror and say, what is it that makes me great and special and can and effective, right? And grow market share. And companies that do that understand that advantage and then take that advantage to not just a market, but a segment of the market that they know that they can win in consistently and grow share. Those are the companies and the management teams that we seek. And they may, in the context of what you said, there may be different strategies around growth and margin, but that's really it. A deep understanding of competitive advantage and where that advantage resonates.
And I might share with VCET, we have evergreen funds, so we don't have a lot of LPs, and the ones we do are very Vermont publicly minded. So our zone is in Vermont for most or all of your business. And our screen is we're looking for founders that are undeniable, right? And businesses that are inevitable. And I think those are the two traits that my partner Sam Roach-Gerber this morning was sharing a bit. And then we've tried to make this very accessible and simplify terminology. We want to know about your team, your tech, your timing, and the terms. We could fill it up with a lot of other stuff, but ultimately that's what it comes down to for our stage of investing, pre-seed and seed and some Series A. So I love exceptions, right? We all have rigid frameworks and judgment comes in, and I'd love to sort of, before we get to questions here in a few minutes, what's an exception look like? Like, Jenny, I'm not really a med tech, but it's so freaking cool, and we have an advantage for our fund and our investors. Like, do you ever stray, or do you ever see yourself straying a little bit adjacent to a pure med tech thesis?
So far, we're in our funnel, in our swim lane, but I'm laughing because there's like 3 deals right now that I know my co-founder would just say, definitely no, definitely no, definitely no. And I'm just thinking, how can we get this done? Let's make this happen. So this is an ongoing.
And what traits, though, lead you to that? Is it
just making money?
Yeah, making money. It's not the connection of the team or their background.
These are deals that I know I have conviction, like someone's going to buy it in 2 to 3 years, and that's our job. So, you can get in the weeds of the technology and the IP and the this and that, all these things, but you're like, okay, if there's a clear path to a liquidity event, is that a 2x? Is it a 10x? Whatever it is, our investors want returns. So that's our job.
All right, so a little bit of coach's decision there. So
I also have to, swim in the swim lane.
And Corey, from a public market investing perspective, do you have, what's an outlier look like, right? Because generally, I want to allocate X% to industrials and Y to health tech. We all know the outlier, power law dynamics. I mean, that's where you find the big returns to pay for the losses and pay for some of the mission investments we all make. So how do you get there?
Yeah, our process is very discerning in that we just believe right off the bat that certain businesses are better than others at the industry level. So I would rather have a software company than a technology hardware company. It's just an easier sale, longer relationship, better economics. But you can convince yourself that a bad business is a good stock because it's so beaten up, and you have an outlook that this series of things will create, a massively better near-term outcome for that stock. And most of our mistakes, which in the public world, if you're only making mistakes 45% of the time, you're doing fantastically well because it's a very efficient market and your competitive set is all very smart individuals. So, finding or when you get convinced that a maybe business that isn't great, doesn't fit your process, you convince yourself maybe it does, you shoehorn it in because your outlook on the stock is so bullish that it finds its way in, and then it comes as you come to find out, no, it was a bad business, it was what you thought it was, and there was no price that you should have paid for that asset. So it's when you find exceptions to your own rules, a little bit like what Jenny was talking about, and when we actually look back within the confines, when we do this, I was talking to Jay about this earlier, annually as a firm, we look back and we present to the whole firm the mistakes we've made over the last year, and they tend to be small in number and large in magnitude, and it can be very frustrating, but I think it's a great exercise, and more often than not, the learning is you either put too much capital into a situation that was too early, or in hindsight, it just wasn't right for the portfolio. So one quick example, we would never invest in an automobile manufacturer, but we did invest in a software provider to the automobile manufacturing industry. And so if our process would have kept us out of that industry from the get-go, why didn't we let that hesitation around that market and the dynamics and cyclicality of it also filter into our analysis of a software provider to that market? So it was a quick, painful, ultimately reaffirming mistake, but that's often the way those happen.
I'm going to just jump in here. We win when others don't see what we see. So we have to build teams and build syndicates and work with other investors, but we also have to avoid groupthink, because if you're just doing the same thing as everybody else, you're just going to be in the same boat, right? So you have to have that winning mindset as to what's different. I think that's a really great question, because if we're hovering around the same institutions or same regions, people get this groupthink mindset, and that's something where we are different. We are open to first-time founders, open to diverse teams. We think that creates alpha, and just really thinking outside the box. It's a lot harder. But I also have a question. I just was curious about, what's your investment committee, or investment committee process? Is it just you or others?
No, so a lot of firms in our industry have an individual that's the PM, and we've built the team and the firm differently. I mean, we have a chief investment officer. I'm deputy chief investment officer. But when it comes to making decisions, our votes are 1 in a group of 10. So everyone on the team, whether you're focused on healthcare, tech, industrials, has to come to a unanimous conclusion. So it can be a bit unwieldy, because getting 10 people to unanimous consent is hard sometimes. But if you step back and you kind of put the process first and it fits the process, people tend to put ego aside and tend to, we do tend to get to that unanimous consent. So it's a bit different versus peers, but ultimately it makes sure that the diversity of opinions on the team gets heard and actually works its way into the portfolio construction.
Great.
So-
Angela. Oh, I'm
Oh, I
sorry.
was just going to say,
Whoa.
so when you're talking to investors, find out their decision-making process. Is it unanimous? Do they have to get 10 people all to agree? Do they have a champion? Do people have their own pools of capital as you're interviewing your investors? What's yours?
What's ours?
Yeah, is it?
We look for people. We'll back people. They'll figure it out. We look for, on a team, I think it's really important to have a hipster, a hacker, and a hustler. Okay? Hustlers sell it, hackers build it, and the hipsters make it just so beautiful or desirable, there's market pull. Okay? That really is what we look for. And then we look for someone providing something that's free and fabulous, right? An Instagram type app, or it solves friction in the enterprise or frustration in the consumer experience. So friction, think hospitals. Why am I filling out this form again? Over and over and over, right? Or frustration, why am I waiting in this line? Is there a better way to get takeout? So that's what we think at the early stage, great businesses can be born and built. So, kind of fun. Geoff, have you had any outliers yet that you can't believe you funded and are so psyched about that? You don't have to give names, but you're early, but yeah.
How long have you been funding first?
Yeah.
Yeah, so our company's not quite a year old. We're 10 months old. I have spent a lot of time in the industry, though, so I'll use my collective experience to answer that. And Dave is absolutely right. Exceptions happen, and they should, right? It's easy to make a loan to a great management team with high growth and high margin and low debt, and right there are policies that and things we look for, but exceptions to those policies are common, and there are still good businesses that have the ability to repay debt that don't meet every aspect of the lending business, and that's what makes it fun and special, right? It's that discretion, and as you might imagine, you hear it over and over, and it comes back to the people. Right, we'll take a great management team and an average business over a great business with an average management team any day. Our approach is exactly like Corey's. We believe there are strong managers in every industry, and those are the folks that we seek to be our clients.
So to steal from my favorite movie, Dumb and Dumber, you're saying there's a chance, right? So I love it. We're going to do a little speed round of questions, and then we'll open it up to the audience here for the last couple of minutes. So if anybody has a question, please make your way to a microphone. Angela, is there a pitch you remember?
Yeah, so I have a pitch I remember because it was bad.
Ooh.
A common issue is that somebody gets very excited about their innovation and their technology, and they forget to talk about the value that it brings. So it happens to us all the time. We are having a normal conversation with someone, and they all of a sudden switch into hard sell mode and just talk about their tech for 20 minutes without taking a breath. And that's really tough to do anything with.
So you can love your tech, just don't love your tech. Got it. Corey, what about you when management companies or management of companies in the public sphere come? Any pitches that you've seen them make that are memorable one way or the other?
Public company management teams are so well coached and manicured that with Reg FD, they're really hesitant to give you too many details. So they're all kind of salesmen, and you just have to be skeptical across the board. The memorable ones tend to be kind of personal nuances that people have, whether it's kind of using your name too many times, to say, that's a great question. And they say it to everybody that asks the question, though. Is every question really a great question? The answer is no. There's no one that sticks out. There are sometimes management teams you sit down with, and it's in a business you like or an industry you like, and you just don't care about the financials, and you want to invest with that person. And that's probably happened 3 times for us.
That was a great answer. Yeah. Jenny, what about you? Do you remember, is any pitch that stands out and why?
Gosh, there's a couple that really do the name dropping thing, right? And they're like, oh, so-and-so's in and so-and-so's in. And immediately I just go, this is not a good fit. So I think it's knowing that audience, knowing what we do and what we bring to the table. Yeah. Oh, I'm going to just do a shout out for the Northern New England MedTech Collaborative. Calvin's right here. Raise your hand, Calvin. There is going to be a pitch prep and a pitch competition and a lot of peer group for founders to help build their pitches. So if you have any interest in that as a founder or a management team looking to do a pitch competition or raise capital, chase down Calvin.
Love it, love it. We've seen about 5,000 businesses over the years at VCET, and two stand out. They actually, two UVM stories. One, a student, Chad Brodsky, who walked in one day as a junior and said, I'm going to solve for loneliness, and here's how I'm going to do it. And he started an app called Shout Out. And then years later, a researcher, Lynn Olignaro, came in and said, chemotherapy's killing people. Here's how I'm going to fix that. And with BioFlag. So we're human. We live lives. And again, for those initial early discussions or approaches, find the hook, be genuine, okay? And you got a better chance than average, because exceptions do happen. And all of our theses based upon your magic, your undeniability, and inevitability of the market you're in. So we have time for one or two questions if anybody wants. Otherwise, I'm going to pepper them with more speed round until they shut the mic off. There's one right here. So, and I've got a VCET T-shirt too for a really great question.
Thank you for your time, firstly. Coming from like a more public sector, like government-funded perspective, I feel like a lot of the ideas that I want to take the time to produce or invest in aren't necessarily very profitable, and so that makes me nervous about coming to investors with an idea that's not really got a wide kind of profit margin. Like if something isn't so oriented towards making the bank the money that it needs, do you have recommendations for other sources to seek out? Like also, I think it's really interesting how there's all these like little niches, you know, like the med tech's very specific. Like I know that there's probably something out there somewhere, but how do you find it, you know?
Is it okay if I go first? So I would first of all say there are different types of value that you can bring to the table. So you might not be able to draw a straight line towards a lot of monetary value, but that just tells you who you need to talk to. So then you know that you're not interested in someone who has to find an immediate monetary return on their investment. You might be coming up with an idea that improves quality of life, and that might be the goal of an organization, and you can find a match that way. So very carefully kind of curating the list of people that you approach really does help. And there's a lot of private foundations with you know, a mission that could match with your idea. It might not be that you conquer the world with that idea. It might stay small. But if you have a really targeted mission in mind, finding someone who can align themselves with your mission is key.
I think it's changed a little bit just in the last 18 months. So 2 years ago, the idea of a profitless, fast-growing company in any industry was much more palatable for angel, seed, A round, B round type investors. The path to profitability has gotten a lot shorter in the last 18 months. So it's not necessarily that you couldn't find funding from a great venture capital fund that maybe specializes in your vertical, but they are definitely going to want to see a path to profitability that, you know, maybe 2 years ago was 5 to 7 years, might be, I don't know, 2 years to 3 years, depending on the stage. Then there's always going to be the seed round where you're not even really thinking about profits, right? You're just thinking about getting to a product, maybe.
think it depends on the industry.
Yeah.
Some people, they're profitable seed round or,
Yeah.
or revenue generating seed round,
Yeah.
which is different than our industry.
But yeah, how many profitable seed rounds
Yeah,
are there
that's
though?
And I think your question too had to do with where to start, right? So reach out to peers that may have built something similar to you and ask them for advice, right? If you ask for advice, you might get capital. If you ask for capital, you're going to get advice. So let's just start with that and build a win. So, and I think for enterprises that might be in a totally different business model or have a different goal, look for an adjacent example. It might not be a pure comparable, but again, you can learn some of the mechanics, some of the funding sources. Investors also generally can have a bunch of personal wealth or foundation wealth that they can invest in as well. So I would offer that. So you really want the T-shirt, Kirk, don't you?
I really want the T-shirt. I was saying, it's so interesting to have four finance sectors up there, and I was trying to think of ways that you're all bumping into each other, and I want to ask about ESG, right? Because this is now a big thing in public markets, and yet it's come up when you said I want a diverse management team. Governance is something that obviously is going to be a concern when you're talking about people going out for debt. So I wonder if you'd all talk about this. This is something that's so much a part of the changes of the last couple of years, Corey. And so I wonder if you just say, because I'm guessing this is one area where you all actually are on the same, almost viewing things the same way, but I could be wrong.
Yeah. Geoff, is that part of what you're looking at?
Yeah, it's not as relevant. So our client base will be typically private companies that have one to several owners that have revenues between a few $1 million and $100 million. So these are companies that aren't focused on ESG issues. And I will tell you, there's nothing in our underwriting that speaks to ESG, or no industry that's excluded because of ESG components. So it's I'd say less relevant in the private debt market where we live.
So I need to be super careful here, because often I find ESG to be contradictory, right? The environmental goals of an organization might be in conflict with someone's social goals or values, and then there's governance, which certain parts of ESG we feel like we've always done. A company's governance is kind of table stakes. You want a good board, you want good governance, like that. That for me is the easy one. Environmental, do you want that to be exclusionary, or do you just want companies that are paying attention to it and improving, right? Because the company that could actually do the most environmentally might be the worst polluter that just improves a lot. So does that fit ESG? So it's a really hot button topic that is just riddled with narratives and hypocrisies. That being said, you mentioned it being a hot button issue. It is much less of a hot button issue today than it was 18 months to 2 years ago. So performance kind of drives narratives, and people care much more right now about making money and good investments than they necessarily do about leading with ESG. So it's complicated. That's the best answer I can give you.
For healthcare investing, everything we do has to save, at the end of the day, hundreds of millions of lives. So for us, thinking about markets that are at least $500 million total addressable market on a global scale, that is one of our top criteria. When it comes to the E and the S and the G, I actually, this is a personal opinion, think they're different buckets. I think the G as an investor is critical. I think governance should be fundamental to any corporate organization and also to nonprofits, universities, things like that. And then the environmental and social, I think there's ranges as to how people differentiate and what they're ranked on. It's definitely part of our awareness, right? We are a 100% diverse-led firm. 100% of our portfolio CEOs are diverse CEOs and management teams. We include things on our term sheets that have diversity initiatives. That is the future of venture, and we want to be the change that we need to be. So,
Yeah, I would just add, we are doing the same thing you are, Jenny. ESG is tough to define. It's tough to define over time. It's super subjective as to what is, what isn't. It's tough enough trying to pick a team you can work with, support, and that will scale. We want to make sure we're aligned with great humans that are solving significant problems in responsible ways. Just like we saw with green economy stuff and some others, there's a little bit of washing that occurs, right? And I would say for those pitching, you got to bring more with your game than a label, okay? We want to know why the team is the one for the job, why the underlying economics or dynamics of the business model, the product, at some reasonable scale, right, when the numbers cross, is sustainable and exciting. And we think the byproduct of that is a great workforce that is well benefited, there's income, there's wealth created, there's community contributions to all of that. So it's not an easy answer, but there's a little bit of snark and suspicion, I think, out there more broadly. So I think we're out of time for this session. So I want to give the T-shirt to right there, okay? Because you took a risk. Thank you. And thank you to our panel. I have one question for you all. Who's asked for money and been told no? Raise your hand. Outside of the house, for a company or a grant or something like that. Okay. That is a shared experience we all have. All right? So look around and go talk to somebody who had and then ask them, how they changed it around. I think that would be great. Thank you all very much to the panelists and for today.
thank you, Dick.